Hi, this is Ramesh. The Economic Survey of India, data is out already, and Dr. Nirmala Sitharamanji, Finance Minister Nirmala Sitharamanji is going to present her last full budget tomorrow. Now, when I say last full budget, it is because the next year's budget is going to be in vote on account, so it has to be discounted. So generally, what happens is an incumbent government, which is going to present its last full budget, wants to ensure that it does a populist budget. It gives a populist budget. The primary reason being that it wants to ensure that it comes to power once again. And for that, they need the votes. So naturally, there will be a lot of SOPs, there will be a lot of reveries, there will be a lot of freebies, and so on and so forth. So that actually the market segment or the vote catching segment actually works for them, and then they get the numbers, and then they form the government once again next year. So that's typically what happens. Okay. But we have to wait and see whether Nirmala Sitharamanji is going to take the populist budget route or the preferred fiscal consolidation route. So because that is exactly what is needed for the markets love it, the industries love it, the investors love it, and that's exactly what is the need of the hour. So we'll have to wait and see what happens tomorrow. And while that happens, actually, I was just thinking that we'll just do a little bit of deep dive to figure out what has happened in the past, in the last year. What has been some of the good things which has happened in our economy, and then what are some of the negatives that actually which is also there, which can cause a little bit of problems, which can impact the budget tomorrow, and then kind of the final takeaways, right? So the first things that I wanted to start talking about is the positives. So in the positives, basically, what has happened is we had the revenues. I mean, the receipts actually, the direct taxes and indirect taxes. Okay, so these two things that it actually kind of consolidates. It kind of they actually are about 90% of the receipts which come in, right? The revenues which come in. So the direct taxes, are the individual taxes, the income taxes, as well as the corporate taxes, and then the indirect taxes are it is the GST, right? Now the GST has been on the rise the last entire year, and then which has also been because of since the pandemic ended, we have had a pent up demand. So the pent up demand has resulted in a kind of a V shaped recovery for the economy, which everyone was expecting it to go that way. And in reality, also, that's exactly what has happened. So, right from the markets, also, which kind of recaptured the heights which it had lost earlier, and also in terms of the GDP, which had shrunk very bad in the 2019-20, 2020-21. It has again picked up steam in 21-22, 22-23 as well. So the direct taxes and the indirect taxes, both of them have actually gone up. So in fact, actually, to give you the real numbers, the last year's, the 23, 22, 23's GDP was about 157.6 lakh crores. I mean, I'm talking about not the real GDP, in the sense that actually which is actually taken against the 2010-11 the pricing, right? So I'm talking about that. I'm not talking about the nominal GDP. So if we take that into account, then the budget expenditure was about 39.44 lakh crores. So close to about 40 lakh crores was the budget. And the revenues, actually expected revenues were around 25 lakh crores initially, which was revised to 27.4 lakh crores. And the expectation right now is that it will end up with about 31.5 lakh crores. So which actually kind of, so if you look at the deficit then, okay, between the 39.44 lakh crores to 31.5 lakh crores, the deficit has actually shrunk from about 11.5 lakh crores to somewhere about 7.8 or 8 lakh crore kind of a thing. So now on this, actually, when you also throw in the asset monetization and the disinvestment that the government went in for, then the borrowing portion has then gone down. It has reduced. So the reduction of the borrowing actually helps in a reduction of the interest payments for the next year, right? So in fact, even if you look at the debt to GDP ratio also, it was in the year 2019-20, the debt to GDP ratio was about 75%. Like typically what they talk about is that the tipping point for the debt to GDP ratio, once it crosses about 75 or something, is when actually the credit rating of that of the sovereign actually starts declining. And so that's exactly where we also got a minus BBB kind of a rating as of now, right? So that actually went up to, in 2021, the debt actually went up to 89.60%, 89.60%. Okay, that further reduced down to 84.55%, and that further reduced down to about 82%. Okay, so now, so which means that actually we are going south when we look at the actual debt to GDP ratio, and then we should actually go back down towards the 75% or little lesser than that, to ensure that actually we are in a better kind of the fiscal condition, so that the investors look at us like a favorite destination for kind to park their funds, right? Now, the fiscal deficit again actually was something which was very bad, which went up to 9.2% in 2021, because there were a lot of extra stimulus and all those things which were given, and then the revenues went down, and then the expenditures had to be maintained, the capex had to be maintained, because if the government cuts the capex, then it is actually going to be there will be a reduction in the job creation. So all of that kind of happened. So the borrowings went up, the revenues came down, and then to match the expenditure, whatever was anticipated, the fiscal deficit went to somewhere about 9.2% kind of a thing, which further was brought down to 6.9% in 21-22, and then which further came down to 6.4% in 22-23. And I'm sure actually by the end of the 22-23, which is the March 31st, I think that the fiscal deficit would have come down to somewhere about 6.3, 6.25 kind of a percent. Now, what is expected by the market and the industry and the global investors and everybody is that the finance minister announces again a budget where she fixes the fiscal deficit to about 6%. Okay, that is a progressive budget, because we are then going in for a fiscal consolidation. So now that can happen because we are regularly seeing a rise in the direct taxes and indirect taxes. And then also we are actually kind of looking at the asset monetization, which has been something that which they have started in the last year, which went we met the target, and I'm sure that we are going to also look at something similar this year as well. So that is something that actually, which is one of the the positives. A kind of couple of positives which happened. Now, the other most important thing is the twin balance sheet issue, which has been a problem for quite some time for our economy, right? So the private sectors, most of the private sectors, were going belly up, and then the banks also had gone belly up. So both the balance sheets were not in good shape. So now what has happened is, because of all this insolvency resolution, which is working big time, the private the sector has been pushed to kind of go in for a deleveraging. So the corporate deleveraging is what they are going in for, and they are basically trying to kind of monetize by kind of getting away some of the assets which they can get away this thing, and then from where they kind of like monetize from that, and then they use it to reduce their debt. So that is what has been happening. Our NPAs are actually had gone up to somewhere about 9.5 to 10%, which was considered to be extremely bad by the IMF and the World Bank and other this thing. So that has now been brought back to 5%, which is actually a very, very decent NPA. And I'm sure that that is also going to go down further. So that is something that actually which has happened really this thing. So now the next thing is in terms of the trade relations, right? Now, ever since the Russia-Ukraine war started, there were a lot of sanctions on Russia, but then India's trade with Russia actually kind of, it improved. It became, much more than what it was doing earlier. And we are actually getting the crude oil also at a discounted price, and also we are getting a lot of among the top five imported commodities that whatever we pick up, they're all coming from Russia, and all of them are coming from a discounted price. So which is actually kind of helping us. And in fact, actually, it's our refineries, most of the refineries whatever we are having where we process the crude, it works well for the Russian crude apparently. So to that extent, actually, it is also helping us. The next is in terms of the disinvestment and asset monetization we already spoke about. So the which is actually kind of helping in reducing the borrowings. And there's a strong growth in the private sector. So most of the companies, most of the industries, most of the sectors actually in the private space, they are showing good growth. So their balance sheets have they have actually turned over their balance sheets, and then their profit and loss also started looking little better. And then so most of them are actually in the profitable range. So like that is helping, because it is also kind of private investments was something, the private investment space was a little not working that very well. So it was only the government which was into a lot of investments, and the private investment was not coming in. So I think given now what is happening, there will be a lot of private investments which will start coming in. Agriculture actually grew to a healthy rate in spite of the unseasonal and uneven patterns of rains. The manufacturing purchasing manager, the PMI, okay, that is supposedly one of the very important economic indicators. So that has actually shown a remarkable rise, and it has become it has actually gone to the risen to the highest levels in the last 2 years, which is very good for the economy. The FDIs, actually, we are having a healthy rise in the FDIs from multiple other countries, actually, Japan, Singapore, UK, UAE, to name a few. So even though that US has been has been reducing their FDIs with us, but it is actually this other countries are stepping in. So that actually shows that there is a very good global reach, for India. And then India is still, actually, the people are, economists are talking about that India will have about, will be clocking at about 6 to 6.5 to 6.8 percentage in terms of the GDP next year, 23-24. And, but even then, it is going to be one of the fastest economies, in fastest growing economies in the world, right? And the forex reserves actually are kind of we have good forex reserves, but then it has actually kind of gone down a little. But even then we still hold about 580 billion-dollar forex, which is actually a kind of decent number to hold, right? Now let me talk a little in terms of the what are some things which did not go well, where we are having some issues which could create problems for our budget. So the first and foremost is that most of the there's an aggressive tightening by most of the central banks all over the world. So they're going to increase, hike up the interest rates, and then once they do that, it is going to slow. There is going to be a global slowdown, and like that is very well known this thing. So I think there is going to be a global slowdown all over, and which is going to impact our exports. And if our imports remain the same, then there will be a huge difference in our current account deficit. The current account deficit is going to go up a little, so we'll have to watch out for that. And the forex reserves actually have come down slightly, as I was talking about earlier, from somewhere about 635 billion dollars. We are now down to somewhere about 580, 575 billion dollars. Now the catch is that even though that 570, 580 billion dollars is still a decent number, But the problem is that actually Indian rupee is no more backed by gold, and then we have switched over to greenbacks. So the more forex US dollars that we hold, our Indian rupee will be strengthened against the dollar. And if there is a flight of dollar from Indian shores, then actually our rupee will start weakening. And which is why actually today the rupee is about 81 for a dollar, 81, 82 for a dollar. And that impacts our imports as well, because our import bill starts going up. Inflation is actually at about 6.8. So which is actually kind of the acceptable number by RBI is somewhere in the range of 4 plus or minus 2%. So somewhere about between 4 to 6% is what actually is an agreeable, or or maybe about 5% is an actually acceptable number by RBI. So we will be actually pushing about 6.5 or 6.8% inflation. So that is going to push up the it is going to reduce the consumption a little bit. So which is one of the concerns which we will be having. And unemployment, actually, even though there has been kind of decent sized, the private sectors are doing well. So the private sector, since they're doing well, they are actually trying to the capacity utilization is going up. And because of that reason, actually there are more employment opportunities which are being there. And then so all of that is there. But then since there is going to be a slowdown, it is also going to impact our unemployment to some extent. FIIs are actually withdrawing hugely from the markets, from the this thing. So there is a huge flight of FIIs which is going out, of the dollars which is going out. But at the same time, the domestic institutional investors are stepping in, and then they are trying to fill up the coffers. So to ensure that the markets are not, feeling the drag. So these are some of the things that actually which we talked about. Now the final takeaways, the final points. India's growth story is still driven very strongly by the economic fundamentals. So our fundamentals are pretty strong. So I think that is what is actually keeping the Indian economy going, and it is still one of the fastest growing economies in the world today. 70% of our GDP is driven by the domestic private consumption. So it's only the 30% actually which we look for the export. So otherwise, we still actually can have a decent sized GDP with our own, because of we are now the most populous country in the world, as we talk about today. So that is one of the reasons why. And then we are putting a lot of money in the hands of the consumers. So the spending potential has gone up really. So that is actually kind of giving them some good this thing. The fiscal consolidation has to be achieved. So we talked about this. So it has to come down to 6%. So given that we have good amount of direct taxes and indirect taxes which is coming in, so I think that has to this thing. There are some 3 or 4 things which we'll have to look for is improve the supply chain to control inflation, because the food prices, the food commodities and other things is what actually drives the inflation. So if we have some better infrastructure and better supply chain control, which the government brings in, then that is going to help to reduce the inflation. Incentivize the service sector for job creation. So the more of the infrastructure and the construction and the manufacturing are the areas where they have to concentrate on, and the government has to incentivize the private sector, whereby it can lead to a lot of job creation. Find new sources for revenue. So that is something that actually which they really have to look for, because borrowings is not going to this thing. As I said, our actually debt to GDP ratio had gone up to somewhere about 89%. And then we are trying to bring it down back to about 80%, and then 80, 82% or something. We have to still drive it down to 75, 70%. So that will, is what actually we have to plan for. And in that case, then the borrowings will have to go down. So we should not be having too much of borrowings. Then we'll have to prepare India to bounce back when the global economy recovers back again, because it's all cyclical. And then I think actually given some amount of time where the central banks again kind of come back, and then they start kind of loosening their monetary policies, then actually things will start looking fresh and looking north. So India should actually kind of go in for a lot of infrastructural spend. So the capex infrastructural spend and also the private now the investment coming in. I think we should actually be going good. And fiscal consolidation route is what Nirmala Sitharamanji has to look for tomorrow, and not the populist kind of a this thing. So that's what I'm hoping, and that's what the markets will be hoping, and that's what even the global investors and others will also be hoping. So so that's something that I thought I'll just share a little bit. Thank you very much for listening in.